G'day, welcome to the Australian Property Podcast. This is our weekly 2 cent segment, and I'm Pete Wargent from Allen Wargent Property Buyers. Now, you may have noticed if you're watching on the video and you're very eagle-eyed, there's no Chris this week. Chris is taking a week's holiday, and in fact, most of the team are, to be fair. I think up and down the country, I think a lot of people have decided to extend the long weekends into an extra long break, and good luck to them. I think it's really noticeable just looking around Noosa Main Beach today, absolutely packed as you might expect, even on a Tuesday as I record this. So clearly a lot of people are taking a bit of time out. So it's just me this week, a bit of a monologue. So I'm just going to go through my predictions and outlook for not only 2025, but out to 2026 as well, because there are some policies are going to come into being early next year, as we'll cover shortly. So yes, I think not only a disruptive time for the economy as people take extended weekends, but actually for the housing market as well. We've got the Easter weekend, we've got Anzac Day weekend with all the dawn services, and then the federal election weekend. So there's very few people taking their homes to auction or listing their properties this week and over the next couple of weeks. So the housing market sort of goes into a bit of hibernation, if you will. So not a bad time to take a stock of where things are. So normally on the 2 cent segment, we cover the big three news stories of the week. And we'll do something a little bit similar this week. I'm just going to go through, I suppose, our three sort of main factors or talking points that people are really interested in at the moment. The first one is what's happening internationally with Trump and tariffs and all of that related turmoil, which is having a big impact in the US and China, but will have a big knock-on impact in Australia as well. Secondly, I'm just going to go through where I see the election going, the federal election on May the 3rd, because there are some knock-on impacts there as well for the housing market, with the two different parties taking slightly different policies to the election this time around. The time of speaking, anyway, looks like we might see the incumbent Labor government get a second term. I think that's largely been the case, actually, over the past 100 years. Usually with a short electoral cycle in Australia, usually get more than one go, and it looks like we'll see the same again. And then thirdly, as promised, we're going to go through what we see, or what I see to be my 2025 outlook for the housing market. I'll pick some of the markets and suburbs and property types that I think might be showing some value. Also, maybe some of the parts of the market that are probably not so much ones to be looking at the moment. So I'll get quite specific later on, so stick around to the end. So let's start with this first point. With what's happening with President Trump. I'm a big sigh as I go into this subject, because it's going to be quite disruptive, I think, over the year ahead and probably beyond that as well. So I think it's interesting because in the presidential election campaign, Trump did talk about the introduction of tariffs, and yet everybody seems to have been caught a little bit by surprise when he followed through and did what he said he would and introduced tariffs all around the world, actually, including even for some countries where there's barely any trade with the US. But the big target is really China. The dynamic over recent decades has been for China to manufacture and produce goods very cheaply and then export them to the US and many other parts of the developed world as well. When Trump wants to redress some of that balance, the US has been running some enormous deficits in recent years, multi-trillion-dollar deficits, and the US has racked up a tremendous national debt of around $36 trillion, which is quite remarkable. So tariffs is one of the ways that is going to try to sort of bring that budget back towards balance, and there'll be some cuts to spending as well. I mean, what you can see straight away, the US stock market at the time of speaking is down by close to 20%. And in fact, the NASDAQ, which is a tech-heavy index, is down by more than 20% from the highs. So we're into sort of stock market correction or bear market territory. I think there's a general sense that if international trade is going to be disrupted on an ongoing basis, you would have to assume that that would equate to lower company profits, lower earnings, and therefore some disruption for the US stock markets. I think if you go back to, well, from 2009, really, all the way through to 2025, depending on when you got in, you've probably been seeing returns in the mid-teens, maybe sort of 15% per annum on US stocks. It's been a fantastic trade, just a totally dominant stock market index. Well, there's been a bit of a change to that narrative potentially in recent weeks. Certainly international investors have been seen to be selling US assets. So not just US stocks, but also US bonds. So we've seen bond yields rising in the US, which is really not what Donald Trump wants to see. That 10-year bond yield has been on the way back up. And I suppose, although the US is still, the dollar is still the reserve currency, there's certainly a potential change here to the world order. So I just want to talk to a couple of the potential impacts of that. Firstly, for the US, and then secondly, to bring it down to the local level. Well, I think even just anecdotally, a lot of people are no longer planning to travel to the US, not just for work, but also for holidays. I think a lot of Aussies probably not that keen on traveling to the US anyway, with the way our exchange rate has been going in recent times. I was over there myself last year for my brother's wedding, and it was just eye-watering seeing the cost of eating out, going to cafes and restaurants, and just general groceries and life in general. Very, very expensive now compared to what we might have gotten used to in the mining boom years. But I think even just the lack of certainty, we definitely could see a bit of a halt to the US economy, not just for trade, but also just for investment plans, for consumer confidence and spending. So the next 3, 6, 9 months could potentially reveal some pretty bad GDP numbers for the US. We might see maybe some companies going insolvent and higher unemployment, the sorts of things you would typically associate with a recession. So that's kind of the bad news, if you will. On the other hand, one thing that consumers will enjoy is that oil prices are facing a lot of downward pressure. It's almost a perfect storm brewing at the moment, with lower investor confidence around the world. The USA has been in talks with Iran. Obviously, the tariffs have created a lot of potential disruption for demand. The OPEC countries have lifted their supply projections. All of this is kind of just lowered oil price predictions, and the outlook is just generally low. So the oil price has been way down at about sort of $60, $65 a barrel. So what does that mean? Well, certainly one thing you'll start to notice around Australia. I was up in Gympie this weekend, just trying to escape the crowds in Noosa, and I was very pleased to see fuel prices there for about 160 cents a litre for unleaded. It wasn't too long ago. We're very commonly getting used to the idea of sort of $2 a litre around the Sunshine Coast. Now, obviously, there's a fuel cycle in Australia, and CommSec does a good job, really good job of trying to track what fuel prices are doing around the country. Well, we're down about 13.5% year on year so far, but there should be an awful lot more to come. If you look at what's happened to oil prices, they've been down 25 or 30% from the highs. I think as the fuel cycle flows through after Easter, we should actually start to see lower petrol prices again. And so that tends to have a really big impact on things like inflation expectations. I guess when you're driving around, the petrol price is like the biggest number that consumers see on a daily basis, not to mention big expense. You might spend $100 filling up the Prado these days, or whatever SUV you're driving, as most people seem to these days. So that's one thing. It will start to bring down not only the price of unleaded fuel and so on, but we'll also generally with oil prices down, you start to see that flowing through to practically the cost of everything that's produced in the economy. So that's really good news for the battle on inflation. Australia has been really grappling with inflation for the past 18 months or so, but we're starting to come down the other side. And I think just more broadly, if you look at what markets are pricing, Australia's government bond, the 3-year government bond, today is trading at under 3.3%. So if you went back not so long ago, last year, we were about, a full percentage point higher than that. Now, this is a property focused podcast, and the 3-year bond yield is an important funding benchmark for Australia's banks and lenders, and therefore it's an important funding benchmark for your mortgage and your mortgage rate. And you'll have seen potentially, depending on which bank you're banking with over recent weeks, you'll have seen fixed rate mortgages falling by up to 50 basis points. We've also seen one interest rate cut in this cycle so far. So, okay, the cash rate target's only come down from 4.35% to 4.1%, but it's a start. It effectively removes the last hike in the cycle from November 2023. But I think more pertinently, if you look at interest rate futures, markets are pricing for a cash rate target of under 2.9% at the bottom of the cycle. And that could come around probably by the end of this year, early next year. So, look, it depends on which major economists you follow, but some of them are predicting 3 interest rate cuts, some are predicting 5. Maybe it falls somewhere in between. We don't know, of course. Things can change pretty quickly and turn on a dime even. But generally, the change over the past few weeks as it relates to Trump has created a lot of uncertainty. I think the attention of central banks is turning very much away from worrying about inflation to more worrying about a downturn in activity, rising unemployment, and potentially even inflation falling away quite sharply. I think China's ultimately got to sell all of its surplus capacity, all of those goods that it produces. If they're not going to the US in aggregate, they're going to be selling off in other parts of the world, potentially at lower prices. So I think the next inflation figures for Australia are due on the 30th of April in the morning on that day. If we get anything like a moderate kind of a reading on those quarterly inflation figures, then the Reserve Bank will almost certainly cut interest rates by 25 basis points in May, and the outlook will probably shift towards some more monetary easing as the year goes on. So what that means for property, a lot of people at the moment might be paying, say, 6.5% on their mortgage rate. Well, any kind of easing from there would be welcome news because we do know a lot of people are in mortgage stress. A lot of people who borrowed at 2% and 3% mortgage rates really weren't expecting to be paying such a high premium on their repayments. Well, we could be on the way back down to mortgage rates at maybe somewhere between 5% and mid-5s or something like that, which would be an enormous increase for affordability for people in the market or serviceability. And historically, anyway, falling interest rates have tended to be quite a tailwind for the housing market, particularly at a time when we've got such a shortage of housing all around the country. And so that's the first thing to say just on the Trump and the international outlook. Yes, it's created a few conniptions in the stock market. There's been quite a few, I suppose, sort of shocks and pulses running through the headlines of the global economy. But at least from a lending market perspective, you probably would expect to see mortgage rates falling over the next 12 months and possibly quite significantly, which is good news for people with mortgages or even prospective borrowers because it just wasn't that appealing to people to get borrowing at, say, 6.5%, particularly when rental yields are sort of in the range of 3 or 4. So the second talking point this week is the election. So at the time of speaking, the polls have shifted quite considerably in favour of the Labour Party. I think I saw a two-party preferred poll today that had Labour on, or somewhere close to 55 to 45. It's a significant lead, and I think the final result will be closer than that. But yeah, in any way you look at that, that's pointing towards a second term for the Labour Party. I think if you look at history in Australia over the past century, it's pretty, it's unheard of, really, for a government to win an election and then not get a second go. We only have 3-year electoral cycles in Australia, which I personally think is too short. I know there's pros and cons to letting people have a decent crack of the whip. But anyway, it looks like the Labour Party, unless something really comes out of left field in the final week or so of the campaign, will be winning. I think $1.20 to about $4, if you believe what the bookies are putting out there. So I think let's take a look at what that means for property. Well, firstly, Labour apparently has no plans to trim immigration. So that's obviously is a big factor on the demand side for housing in Australia. Student visas are already at record highs. The stock of international students in the country, I think at the margin, there have been some moves to make university applications a little bit tougher for international students, and that will probably slow down at least the rate of growth in student visas. But in any eventuality, I think the student numbers are going to persist at record highs and probably keep making record highs. You may have seen there was an article in the Australian Financial Review this week saying how migrants from India and Nepal will be able to bring in tens of thousands more via their extended families, more people into the country. All of these things have a sort of impact on the housing market. Initially on the rental market, most new arrivals to Australia are renters more so than buyers, at least in the early years. But it's still at a time when rental vacancies have been close to all-time lows. It's a politically sensitive subject. I do think, though, despite that, if we look forward over the next couple of years, I think we'll see the rate of population growth. It will naturally fall back towards around 1.5%, or maybe even a bit lower than that. We've seen a very unusual 5 years where net overseas migration effectively dried up. And in fact, we lost a lot of our temporary visa holders, international students and backpackers and tourists. A lot of those people just weren't around during the early phases of the pandemic and the lockdowns when the borders were closed. Of course, over the past couple of years, they've all come absolutely roaring back to the extent that we've added 1 million or so extra people in the space of 2 years. Now, that's not going to continue at such an electric level. The housing market simply can't respond that quickly. So, of course, we've had a rental crisis. Rents have absolutely shot up, probably 40% in a lot of cases. And I think if you take a look at the outlook, well, let's take a look at what Australia's federal budget says. So for 2025, we're expecting to see net overseas migration. So this is by financial year. Net overseas migration slowing from 435,000 to 335,000 by June 2025. And then the forecast is for a slowing to 260,000 in FY 2026 and 225,000 in FY 2027. So there's a couple of things to say about that. One is that the government's forecasts on both sides of politics have typically undershot the reality for a long, long time. The only time when they didn't really was during the COVID period. I think if you look at ABS projections going back over the years, they've tended to underestimate the sheer power and strength of Australia's immigration program, pushed along by both sides of politics, and also the intergenerational reports have explained the potential benefits for slowing down the aging of the population, um, for increasing the participation rate in the economy, the number of people that are working, and therefore the tax take, record tax take in this financial year. So both sides of politics really sort of like to keep immigration running very high levels for a developed country. And so I suppose if you look over this financial year and the next two, at face value anyway, the budget is forecasting net immigration to slow down quite a bit. Don't forget, we also have natural growth in the population in Australia, more births than deaths, at least for the time being. We're not like South Korea or China or Japan, where things are tilting in the other direction, largely because we bring in relatively young migrants who then go on to have their own children. So I think if you look at what the outcome for the election is going to be, I don't think it will be dramatic shifts, but I don't think we're going to see big cuts to the immigration program. There's certainly no noise has been made in that direction. And I wouldn't be at all surprised if immigration actually proves to be quite a bit higher than is forecast in the budget. So if you look over a couple of financial years, we might see an extra or 600,000 or 700,000 people in the country. It's a lot of, when you put it like that, it's a lot of people. It's a lot of demand for housing. And we're really only building at about 40,000 dwellings or so a quarter, nowhere near the government's target. The other thing that will come out of the election, Labour Party announced a little while back, 5% deposits for first-time buyers. Now, this is a game changer. The government will effectively not require lenders' mortgage insurance. The government will have a guarantee in place and have your back as a first-time buyer. And the price caps have been increased quite significantly. So that scheme will be put in place for first-time buyers up to 1.5 million. Price cap in New South Wales. It's about 1 million for Victoria. Same in Queensland. So really covering the vast bulk of first-time buyers. And I think what that's going to mean, now this comes into place in January 2026, but I do think it will mean that any first-time buyer who can scrape together a 5% deposit is going to be saving that deposit and potentially shaking the tin to parents and grandparents because, well, we've seen all this before with stamp duty exemptions and first homeowners grants. It creates a kind of self-fulfilling upward spiral, and first-time buyers feel this is an opportunity they don't want to miss out on. And the last thing they want is for entry-level properties to shoot up in value because the government's introduced a 5% deposit scheme, only for them to miss out. So I think it won't happen immediately, but from January 2026, there will be a big take-up of first-time buyers using the 5% deposits or just looking to buy in general. So, yeah, it's an interesting, shall we say, policy. I'm not sure it's a great idea. Now, I've seen some of the think tank studies that say this could potentially improve affordability. Look, it's I think that's well, it's somewhat wishful thinking. Let's be honest. It just pulls forward demand from first home buyers. Now, the government is pledging to build 100,000 homes, providing $10 billion over 8 years for first home buyers specifically. Now, if you break it down by year, that's only about 12,000 dwellings a year. That's even if they get built. We've seen enough of these programs over recent years where the government has pledged things that just don't come to light. It actually was one of the factors, no doubt, that ended the Ardern government in New Zealand, where there was a similar pledge made to build tens of thousands of homes. They just never materialized. I think the thing to look at when you piece all of this together is that there's probably no major disruption here. We don't get a change of government, most likely. Immigration continues at pretty high levels. We get the 5% deposit scheme, and there's nothing new really in the budget that's going to see a quick turnaround in housing construction. So we can be fairly sure that the housing shortage is going to get worse before it gets better. Now, finally, let's finish with my outlook for 2025 and 2026. Now, I mentioned in the immediate term, we've got a lot of disruption. We've got Easter, Anzac Day, federal election weekend, all of these things are disruptive to new housing supply coming onto the market. And I think stock for sale in the housing market probably won't pick up properly until the spring selling season. And by then, interest rates will be lower. As I mentioned, I think we've got a structural undersupply of housing in Australia. We built about not even 60,000 or 65,000 apartments last year. It's just nowhere near enough for the amounts of people that we've been bringing in. We're constructing dwellings, maybe 40,000 or a bit more each quarter. The government's target is around 60,000. So we're just cumulatively and consistently nowhere near that. Mentioned previously, interest rates are on the way down, maybe not dramatically. But I think if you look at housing markets around the country, well, Southeast Queensland, where I'm based, that's really a momentum play. The Brisbane Olympics announcements showed that there'll be a massive range of infrastructure announced. Victoria Park, new stadium at the showgrounds around Bowen Hills, new stadium at the Centenary Call, new stadium at a tennis centre down by the river. The Gabba's going to get redeveloped for an entertainment centre, some new housing, and there's the Cross River Rail. So there's just endless infrastructure investment. It's been quoted as 7 billion, but I wouldn't be surprised if that figure's probably somewhere near a 20 by the time it all plays out, the way the pricing seems to go with unions in Southeast Queensland. So I think it just generally, there's an awful lot of people still moving to this particular part of the country, from Sunshine Coast down to Brisbane, Caboolture, Ipswich, there's Deception Bay, Greater Brisbane more broadly, but also the Gold Coast, the hinterland, and we're just nowhere near keeping pace on housing supply. All of that infrastructure is going to take away scarce labour and materials away from housing construction. It's also pushing up the price of labour and materials. And so I think we're just going to have a sort of it's a bit like a sort of Groundhog Day at the moment for Southeast Queensland, just an ongoing shortage. I think the number of units approved has picked up a little bit, but without the foreign investors in the market, there's just no way we're going to get housing supply meeting demand for a long time to come. So a bit different from what we saw in 2016 and 2017, where we had a lot of Chinese investors from overseas in the market, and we got a big construction boom for high-rise housing. There just isn't the demand for that kind of product this time around. First, the stamp duty surcharges have effectively locked out that part of the market. So the only places where we're really seeing housing supply, Gold Coast, we're getting some apartments out of the ground, more of the premium end, generally speaking. I think developments where you've got a nice maybe ocean outlook and things like that, but that's just an ongoing kind of shortage. I think if you're that's kind of the momentum play. I think if you're more of a mean reversion type of investor, and I think that would include me, and no doubt a lot of other people, no doubt a lot of other listeners as well. I think Victoria, and particularly Melbourne, is probably the place where the most value for money can be found. Melbourne's doing a little bit better on housing supply. I think if you look at Sydney, unit prices just aren't high enough to get developers interested. I think some developments are happening in Melbourne. Build to rent is definitely much more amenable in Melbourne. But I think if you look at, well, I'll start with the unit market. If you look at places like Prahran and Elwood and St Kilda, this is just like an action replay of Brisbane in 2020. I think so many people have been put off from buying units in Melbourne because they've seen maybe 10 or 12 years where prices have been stagnant. But we saw exactly the same thing in Brisbane up to 2020. We maybe had a dozen years where even in nominal terms, prices were just went absolutely nowhere. And then we reached a critical point during COVID when interest rates fell. And then suddenly unit prices absolutely rocketed, maybe 60% or so in 3 years. And in some cases, they doubled. So a dozen years of nothing and then a super boom in prices. I wouldn't be at all surprised if something similar happens in Melbourne. Maybe not quite so dramatic, but I think if you buy the right type of product, an established 2-bedroom unit in one of those really sought after areas like Prahran or somewhere like that, I've got some money set aside in my self-managed super fund. So full disclosure, I may well look at something like that myself. Now, maybe it's a short-term play and you're looking to get an uplift in price and then maybe sell the property later in the cycle. But I do think there's tremendous value there because you just can't build a unit for 500k these days, let alone some of the prices where units sitting at the entry level. I think if you want to buy a house in Melbourne and you want to get that land to asset ratio higher and get something with a bit more scarcity value, sure, you may need to go out to suburbia to get some more affordability and to make those yields work. But again, I still think there's good value out in suburban Melbourne. Where else? I think we're quite active in coastal New South Wales. We've been doing a lot of stuff with clients in the Central Coast at around 800k if you want a house. Sunshine Coast as well, 800k. You do need to look quite hard, I think, on the Sunshine Coast to get that kind of value now. But the opportunities are there. Newcastle the same. And I think in Sydney, I think there's just a massive undersupply of housing. It's a very difficult entry price for a lot of people, for investors, I think. But if you look at units, for example, we're just not building in Sydney, and there's a chronic undersupply of housing building up there, which will probably result in a pop higher in unit prices, I would think, over the next few years. House prices are already at 2 billion asking price, so it's a difficult prospect for a lot of investors, although home buyers will no doubt be interested and active, as they always are. So just to wrap up, I think market pricing is for lower interest rates over the next, I guess, 8, 9, 10, 12 months. Labor is introducing 5% deposits for first-time buyers from January 2026. The housing shortage is just ongoing in so many parts of the country. I think maybe some other parts of the country are seeing prices get towards the peak of the cycle. And obviously Perth and Adelaide have had a tremendous run over the past 5 years. Probably harder to find value in those markets than it once was. But there's certainly still a shortage in many parts of the country. I do think, though, with those dynamics, I think in nominal terms, probably every capital city will see higher prices by December 2026. Obviously, there's always things that come from left field, but just look at all the different dynamics that are in place. Not enough housing. Lending standards are very tight still, with the 3 percentage points assessment buffer for borrowers, but that could easily be wound back as well. But I think the market cycle will be driven from the bottom of the market upwards. I think it's that the first home buyer boost is really going to be the embryo of this coming cycle, and then things could potentially build from there. Now, looking further ahead, I think we will eventually see the big supply response that everybody wants. I think at the moment it's really hard for developers. We've got lots of taxes and overlays and costs for developers. Interest rates are high, difficult to borrow even for developers at the moment. But that dynamic will change eventually. I think construction costs will level off. So if you're an investor now, you may well get a tailwind for the next year or two. But do remember that supply response will come at some point. So try to remember getting a good land to asset ratio and try to find properties with good scarcity value and do all your numbers. Make sure the cash flow works. Generally, property works as a longer term investment in Australia, with the costs on the way in and on the way out. So that's about it from me this week. It's been a very, very busy week on the Sunshine Coast, and it looks like that's going to go all the way through to Anzac weekend as well. And so have a cracking long weekend, whatever you're doing. Dawn service for us this week. And yeah, hopefully a bit of time off as well. Next week, Chris will be back. And in the meantime, we're doing a couple of other episodes with Owen And we're doing a listener Q&A as well. So do send in your questions, as we always like to cover those in our 2 cents segment and also in our Q&A episodes. So if you want to have a chat, the links are always in the notes. Always happy to have a phone call or answer your questions. So get in touch there, and look forward to catching you next week. Cheers.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.